Welcome to another Leumi Financial Corner. With us once again, Michael Zaremsky, head of U.S. Private Banking, Bank Leumi USA, member of the Investment Committee for Leumi Investment Services. Michael, good to have you back again. How are you?
Thank you very much, Zev. Great to be back and looking forward to our conversation.
Breaking news. The Feds raised the rates. I guess it was expected they were going to do so. How does it change things? What do you read into what the new situation is now?
Sure, Zev. That's a great question. And again, very timely given the rate hike that was just announced across the tape. So first off, I would like to just reiterate that the views being expressed are my views, not necessarily those of the bank or the broker dealer. Having said that, I think that the market has really been anticipating this for quite some time. We've talked about it in numerous conversations that we've had, and this is the very beginning phases of the normalization of Fed policy, or at least the next stage in the series of normalization of Fed policy. Again, for everybody paying attention, the Fed cut rates by 150 basis points at the outset of the pandemic. And before we even get back to where we were almost 2+ years ago, we have to hike 6 times. In some of the language and some of the data that was produced by the Fed, the anticipation at this point from the Fed governors is that we'll likely get about 7 hikes in 2022, and then we'll continue on with the rate hike cycle through 23 and 24. I think a key element is that the statements from Fed Chair Powell were quite guarded in terms of going slowly, not moving too aggressively, watching the data and seeing how everything progresses out. So again, I think that we're on the road towards normalcy. We're on the road towards stabilization. And I think that we're seeing this in a lot of different elements of what's happening in the economy and the world.
So how does the war in Ukraine and change things for the long-term picture? Do we have any idea?
I wish I was able to give some clarity. And as we've spoken previously, it's very difficult to really get any information that is differentiated from the news that we're all hearing and seeing. Clearly, from a human aspect of it, it's a great tragedy. And my general view, and I think the common view, is that there's probably going to be more destruction happening before we get an end to this. But what does seem to be happening, as opposed to where we were a couple weeks ago, is there seems to be a little bit more of a stabilization in terms of where we are, in that war process. The early onset, people thought that there would be a lot more of a swift Russian taking over of Ukraine. The sides have kind of settled into some lines of demarcation. And it does seem that the two sides are talking a little bit more aggressively in terms of ceasefire and how to get out of the current situation. So I certainly don't profess to have any knowledge beyond what most of us are seeing on the news. But from a fact of where it is in kind of the pecking order of news stories that are creating anxiety and uncertainty, it seems to have abated a little bit, again, outside of some of the horrendous pictures that we see on the news every day. So again, I think that the Ukraine war certainly has added to a lot of volatility. It's certainly unsettled a lot of the energy markets and any elements of the economies of the global economy that has to do with Russian trade. We saw some crazy volatility in the oil markets. Prices spiked up, prices came back down. Everybody sees it at the gas pumps right now, with fears of supply and demand imbalances continuing for longer than expected. So from an economic standpoint for the U.S. Investor or the U.S. economy, it's certainly a wild card, and it's certainly a situation that we need to pay a lot of attention to because of the uncertainty. But where we are now, as opposed to where we were a couple of weeks ago, we probably have a little bit more stabilization of what that situation looks like. But again, more broadly, I think that the question is, how is the U.S. economy holding up? What do we look at the world going forward? And as we've talked about many times, Ev, the market is really a forward discounting mechanism for the next 6 months or so. And I believe that the market is really starting to look out beyond some of the near-term events deeper into the fall season. The economic activity continues to be robust. We got other data that came in from the markets earlier today, which again supported the concept of a relatively healthy and strong economy. Employment data continues to be rather healthy. And we are seeing interest rates pick up to kind of reflect this normalization of policy. So again, I think that that's the general pathway of there are elements of seeing some inflationary trends maybe abating a little bit. Again, oil prices have kicked down. We've talked previously about certain changes possibly happening in the auto markets. Again, that counterbalances with some of the supply and demand imbalances that we're seeing, again, in part because of some of the issues with the Russia-Ukraine war.
So I would assume as things stabilize a little bit, and the markets always tend to be forward-looking, so that's a good thing as far as the financial markets are concerned.
Zev, I would agree with you, and I think we've talked about this before too, where this is the worst pullback that we've had in quite some time. The last 2 years have been rather docile in terms of volatility post the initial pullback from the onset of the pandemic. Right now, I think the debate is this a normal correction or a normal retracement, or is it something more than that? We do seem like we may be having some signs of bottoming. We are seeing some more buying activity step in. The fears that people had several months back about markets being, over, too expensive or, overpriced have abated. And I think what we're also starting to see now is a rotation away from some of the, the stocks and the stories that may have really led the way during the pandemic into kind of more the traditional value companies or some of the cyclicals that will do well in a rising interest rate environment. So you're seeing, generally speaking, the financial sectors are taking leadership. We've seen energy take leadership. So we're seeing some rotation through the markets. And I think it's important to try to stay balanced in terms of, not being too far offside in one particular sector or one particular theme versus the others, given some of the uncertainty and the volatility that we're seeing. So at this point in time, I also do think it's a really good idea for everybody to take a pause, take a look at their portfolios, take a look at their goals, and make sure that they're well positioned to achieve their long-term needs. As we've spoken before, and again, particularly last week, if you have short-term needs, again, tighten up the asset allocation more towards cash, more towards safety. If you're invested for the longer term, again, I think that it's a good opportunity right now to think about where do we go from here over the long term and not make any radical changes unless something in life has changed your circumstances.
Michael Zaremsky, head of U.S. Private Banking, Bank Leumi USA, member of the Investment Committee for Leumi Investment Services. Thank you for sharing your insights. And we're going to be right back. Don't go away. Stay tuned.